As you logged in, you saw a disclaimer for my Chief Compliance Officer that's on the line. Welcome, Kimberly. This just basically says that you won't reproduce or reuse our information provided in the seminar without our consent. Again, my name is Bill Biden. I'm the President and CEO of Capital Wealth Advisors. I've been in this industry for over 25 years, focusing much of my career specifically in the areas of estate planning for high net worth families around the country. Today, I'm proud to lead a team of just about 50 people in our firm, Capital Wealth Advisors, where we serve families around the country and some multinational families, not only in the areas of wealth management, but really specifically helping them plan around financial, estate, and retirement planning. As a firm, many of you are familiar as I see the participant list, and thank you for being on today. We're at about 1.8 billion today in assets under management. We focus on estate planning, risk management. Obviously, wealth management is a key part of our business. And we also have a family office division in the firm helping families operate their daily lives in retirement. Today, again, we're going to talk about potential estate tax changes and the impact of those on our estates. We're going to talk about broader tax implications from the proposed proposal under the Biden administration. We're going to look at a case study, and then we're talking about key takeaways and sort of action items that help you as you move forward in your planning. So President Biden was a little unique in that he and Vice President Harris, along with some of their team members, specifically Bernie Sanders, put out their proposed tax plan in writing, which was very unusual for someone in a political campaign. But it really gave us an opportunity to understand the thinking behind where they want the tax to go in a variety of areas, and then giving us opportunities to find ways to plan to minimize the effects of those. So I thought maybe the first I'd start is kind of highlight what the proposal is, and we can, if you'd like a copy of this, we can send this out after the presentation. If you just want to shoot us an email, we can do that, or put in the Q&A section. I will have time for questions and answers throughout. If I don't get to your questions today, we'll answer them offline, but feel free to use the question and answer section of the portal today. So highlights of the Biden tax proposal are: first is to reinstate the 39.6% top income tax rate for top earners. This is sort of a rollback of the Trump era tax decreases that we saw. Wants to increase the capital gains tax from 20 to 28%. But the kicker is that if you have $1 million of gain in a given year, it would kick the rate to 39.6%. Wants to increase the corporate tax rate to 28%, and also uncap the 12.4% Social Security payroll tax on earnings above 400,000. So in today's world, as many of you know, your SSI contribution is capped at a certain level. Now that would be uncapped, adding an additional 12.4% for high earners over 400,000. Some good things in the plan. He wants to reinstate the ability for us to deduct state local property taxes as well as mortgage interest. So that would be a benefit to the plan. From an estate planning perspective, the goal would be to reduce the unified credit amount. Initially, when the plan came out, it was talked to reduce it from the current of 11.7 million per individual to 5 million. Since then, it's been revised to 3.5 million, which means we would reduce the ability for us to pass assets tax-free at our death, and each individual would have $3.5 million of unified credit under the proposed plan. Now, all of the things that we're talking about today are subject to political negotiations, interactions that are going to happen in the House and in the Senate and with the current administration. So this is the sort of the wish list, and we'll continue to monitor it as we go along to see where it really shakes out and when. Historically, changes that have happened in the calendar year have been made retroactive back to January 1 of the current year, which means that ours would be effective of January 1, 2021, excuse me. And if that happens, planning that occurred last year would be in place, but anything that you do this year, we'd have to adjust to make sure that we're within the limits of the new unified credit. So we will continue to monitor that. We will continue to provide information and real-time data as it comes out. Consensus that we're hearing from Washington is that There's a likelihood that this gets pushed into the next calendar year based on all the other agenda items that are out there, but we won't know until the year continues on. So again, from an estate tax perspective, the idea would be to cut the unified credit exemption amount down to 3.5 million from 11.7. They do continue to have portability, which means that if I were to pass away without having captured my credit in my plan, I could be transferred to my spouse as long as it's filed on an estate tax return at the time of my death. That is not changing in the proposal as of yet, which is actually a good structural change that happened several years ago. In addition to that, the current rate is 40%. In the Biden plan, the rate begins at 45% and graduates up to 55% for larger estates. And for extremely large estates of $1 billion or more, the proposal is to have the rate at 70% for the largest estates in America. We think about that along the way and understand that on average, what we feel with our families be somewhere between 45 and 55% based on the average clients in our relationship. So we're going to use those rates as our examples today in our case studies. Arguably the most important proposal, sort of in my opinion, one of the worst things in the proposed plan is the elimination of the basis reset, or was referred to many times historically as the step up in basis, which is the elimination of capital gains upon death. So under the current law, if I had an investment that I have a cost basis, let's say of $1 million, and I die and that investment is worth $2 million, my heirs would be able to sell that asset and my basis would reset to the value at the date of my death. So my $1 million basis would reset to $2 million, and therefore my heirs could sell that without incurring any capital gains tax. If we eliminate that, if you just think about that, not only would you have an estate tax, but you would have an income tax on the unrealized gain in all assets that you would have in your estate over and above the estate tax, which could be a devastating tax for families. In addition to that, the Biden plan really shifts it from an American US sort of tax-based model to a Canadian model, in the sense that the income tax or capital gains tax due with this new change would not be due upon the sale of the asset, it would be due upon the transfer of the asset. So you would have the transfer of assets that was subjected to the federal estate tax, and depending what state you live in, maybe a state inheritance tax. And then when the assets transfer, unembedded gain would become immediately taxable. And if we go back to my earlier outline, any capital gain over $1 million collectively in a year would be taxed at 39.6%. So if you think about it, you could have a 45 to 55% estate tax over and above your unified credit, and then you could have another 40% roughly, give or take, tax on the unrealized gain in the estate. So again, could be a devastating sort of tax change for many families. That being said, there are opportunities for us to plan to minimize that over time. This is a graphical interpretation, kind of comparing the different rates between the current Biden administration and what was in existence in still currently, but what was really through the time of the Trump era. As you can see, the comparative of corporate taxes, income and payroll tax combined. I think it's important to look at that collectively, because with the uncapping of the Social Security tax, you end up with a top tax rate of around 52%, not including state income taxes, depending on where you are resident. And obviously from a capital gains and dividend tax rate would be a substantial increase to families. So we think about this sort of the potential impacts on estates. Again, the first is going to be the unified credit, a reduction. We're historically high at 11.7 per individual. Reducing it to 3.5 million obviously would subject many more estates. The step up in basis, which we talked about, has an issue with regard to that unembedded gain now being due on transfer. And then the sort of the salt in the wound would be if an estate had a gain of more than $1 million, it's going to throw the rate to the 39.6% rate. So it's really a triple threat, if you will. A lower threshold means more taxes on estates, again, from 45 to 55% on a tax rate. but dramatically more families would be subject to estate tax under the proposed regime. The elimination of the step up would not only force taxes to be paid, but also force assets to be sold. Because if we have to come up with the liquidity to pay an estate tax and an income tax, more assets are going to have to be sold. Depending on where we are in economic cycles, that could be a disadvantage for families that have to sell at the wrong time. And then with 39.6% of that potentially going to tax, when you combine that with the estate tax, it could be something that would erode millions of dollars in family value as you move things down to generation. Another thing that's been talked about and written about quite a bit is if you think about just the capital gains tax and the basis reporting. We've had basis reporting for the last 4 or 5 years on estate tax returns, but imagine if you have to go back and research the historical cost basis of every asset in your estate and passing on to your family. It will result in a much higher, in my opinion, much higher legal and accounting costs for estate settlements. So as we think about this, it's not just about the tax, it's about all the other ancillary expenses that come along with it. And again, why we're talking about this is that in the current political environment, it's highly likely that some, if not all of these, will be enacted in the near term. So tax implications. I always say that I've been doing this for over 25 years. Everything changes, but at the same time, it always stays the same. I have seen many changes in the estate and gift tax laws, income tax laws over my lifetime, as many of you have. The estate tax has been repealed and reenacted 17 times in our history. Many times it's been reenacted to help fund some major debt. If you go back in long dated times, in the 1800s, it was brought back to fund the cost of wars, military actions. Obviously, we have an ever-growing debt in the United States, and the politicians will need to find ways to pay that or eliminate or reduce that debt over time. And many will look at that from a tax generation perspective. The estate tax is an easier one because typically income taxes are more voter sensitive than estate taxes. So they're looking to this as a generation. In addition to that, I think culturally and politically, we're in an environment of many, depending on which side of the aisle you sit on, have a view of the redistribution of wealth. So that also from a policy perspective is something that the Biden administration believes in based on what they've written and what they've spoken about. So that also is a second reason why they're going to push this tax agenda through. So where do we sit today as it compares to history? So again, today, 11.7 million for each family. Each individual can pass tax-free to death. So a married couple, 23.4 million. And if you look at this chart that I've printed here, looking at history, the dark blue bars on the bottom represent the exemption, which historically for a long period of time was very low. And then this lighter blue line coming through here looks at the tax rate. And you'll note at a period of time event in 2009, 2010, we had a period where we had no estate tax, and that's why we have the big dip. But what strikes me as unusual, if you look at history, you can see that compared to history, our unified credit is dramatically higher today than it has been historically. So even though the proposal is to reduce this down to 3.5 million, it does put it more in line with historical exemptions that we have had in our time period. So we've enjoyed for the opportunity to transfer assets in the last several years with a high exemption, but the likelihood that it reverts to the historical is probably pretty high from our view. I always think this is interesting when you think about it. When I first moved to Naples in 1998, the unified credit was $600,000. So if you can imagine, if you were in Naples and you were a homeowner, you had an estate tax issue, and the top rate at that point was 55%. So when we look at that indexed over time, they're really trying to pull us back to that historical average that existed, 23 years ago. So what I thought we'd do is kind of walk through sort of a comparison of an estate. So you could see the differing impact of current law versus proposed, and what that looks like from a planning perspective and what it looks like from a tax perspective. In this example, the comparison of this, we're assuming a married couple, and we're assuming the tax is due at the second death. So under the current scenario, we have 23.4 million that is available for tax-free transfer. Under the proposed, we have 7 million. We used a blended rate of 40% for the current rate, 55% for the rate in the proposed. And we assume in the capital gains tax, in this example, we assume that 50% of the assets are liquid, 50% are illiquid, and half of the assets have a gain in them. So that's where we've projected the math. So in the current scenario, there would be no income tax paid. In the proposed scenario, there would be an income tax paid with that capital gains tax. So we look at that and we look at an estate today and we grow that estate just at 6% a year. And we look at it in varying years as time goes along, the impact is pretty substantial. So the estate tax obligation grows substantially under both scenarios because we have assets that are growing and those growth assets continue to get taxed. But under the proposed law, the numbers are obviously much more substantial. So in year 10, it's 3.4 versus 17.4. Again, starting from the same starting point, we have a much larger tax. When we look at year 20, 11 million versus 26 million. And if I go out 30 years, a longer life expectancy, depending on the age of the clients, 23 million versus just under 40 million. One thing to think about is not only do we have the tax to deal with today, but we have the growth of our estate. So there are many techniques that we can employ that help us move the growth of the taxable estate off of the taxable page, giving us the ability to minimize this future growth of the tax. And as we go through the process over the next 3 sessions, we'll talk about some of those techniques that we can employ to do so. So when I look at this from a perspective of how we analyze estates and what we look at, this is an internal document that we use. But when we look at it, if I took the liquid and the illiquid assets, in this case, we just did a 50-50, we get the total estate value here at 25 million. We look at the estate tax rate, giving us the total taxes owed. Again, in the current tax law, we have no income or capital gains tax on the assets. When I look over here in the second scenario, not only do I have an estate tax, but now I have a capital gains tax on the gain. So I take the liquid assets and the illiquid assets. And when we look at that, it gives us total estate value, but we have a capital gains tax of 4.7, 9.2 on the estate tax rate, giving us a $14 million tax. So obviously a substantial difference just from one scenario to the other. But important to understand, a 64-year-old couple 64, which is our assumption, have a very long life expectancy. So as I look at this over time, the numbers actually get a little more dramatic. So we have taxes in 10 years with growth. You'll note that these assets grow to a point that we have a $3.4 million tax under the current scenario and a almost $17.5 million combined tax. What's important to understand is most of us have liquid and illiquid assets, and depending on your careers and how you made your wealth, many times we have very differing liquidity profiles. In our third session, we're going to completely focus on liquidity, but I thought today it'd be important to point out, if I look here in this second scenario, my liquid assets are 14.2 million. My taxes are 17.5. So I have more tax than I have liquid assets, which means that I'm going to have a forced liquidation of some illiquid assets, or I'm going to have to find a way to finance the tax, which is due 9 months from the date of death, so that we can fund this value. So looking at liquidity and the tax together is very, very important. As I said, in the third set of the series, we're going to focus on that and really dig deep into that so you can understand that. There was a study by a company called WealthX several years ago that looked at Americans, and what's interesting is at the average wealthy American, they define wealthy American as a $20 million estate and up. As they aged, their liquid assets declined and their fixed assets grew because they were living on their liquid assets. Many times their philanthropic endeavors are funded by liquid assets, and their fixed assets continue to grow. So the average 83-year-old in their study had liquid assets of about 32%, if I'm right, plus or minus, of their total estate. So when we think about that, we need to understand that we have to figure out a way to plan for liquidity in any given time from an estate perspective. And as you can imagine, the further we go along in this, the worse it gets, because as the estates grow, and in this case, we're keeping the ratios of liquid and illiquid equal, but as we know in reality, as I just said, that may not be the case. So as I look out 20 years to age 79, that's 26 million in tax versus 11. And if I go out to life expectancy for a joint couple of 64 in good health, that's age 92, 44 million versus 28. But again, keep in mind 44 million versus 32 million of liquidity. So again, potentially devastating from a planning perspective. So those are things that I think are very, very important for us to look at as we go forward. So as we look at this from a perspective, the two big differences I think to understand as we look at is we need to focus in our reviews and analysis of estates where we are from an embedded gain perspective, as well as where we are from an estate tax perspective. So when we think about this in today's world, last year we had some families actually pay some capital gains taxes in advance with the thought that the estate tax laws and income tax laws were going to change. But now we have to monitor that, and we have to understand, are there opportunities for us to potentially adjust our cost basis through transactions, selling assets, doing things in advance and preparing so that we can minimize the tax over time. Looking at the liquidity, do we have liquidity available to pay tax, or do we have resources outside of our estate, either through gifted assets in trust or insurance benefits that are outside, life insurance benefits in trust? Do we have anything that can adjust for us to help us fund those tax obligations as we go along? So again, important things to think about. So when we think about key takeaways from what's happening from a tax regime standpoint, the first is we see a huge value today in reviewing your estate plan. Not only the documents, and they're very important, and there are many things to look for and that we see every day, but also looking at the financial aspect and projections of that, really understanding what's the potential impacts of current law versus proposed law, and are there techniques and are there things and gifting strategies that you can utilize to help us minimize that for your heirs. When we review and look at, we see, literally hundreds of estate plans every year. It's important to look at how your assets are distributed as well. The most common thing that I see that gets adjusted over time is that plans are put in place when our children are younger, and we have this idea in old style planning where we would distribute the assets them at specific ages, 30, 35, 40, 45. Under sort of the current planning that is most, I think, most useful, instead of leaving assets outright to our children and grandchildren, we leave those assets in ongoing trust for them. Trust does not mean that we limit their control unless there's a need to have a third-party trustee, but it gives us the ability to have those assets in a vehicle that is not going to be subject to the claims of divorce or creditors or lawsuits. And we feel very comfortable in having seen these tested over time, that by leaving them in assets in trust, so as an example, instead of it coming into my personal account and I put it in my joint checking account, it goes into the trust for the benefit of Bill, or the trust for the benefit of my daughter, Emily. And Emily, in that example, can open an investment account in the name of the trust. She can buy assets in the name of that trust. But if she's ever divorced or sued, those assets are protected for her. And we think that's really an important consideration as we look at our planning. So when we talk about important things to do today, the estate analysis, the document review, very, very important. We spend a lot of time looking at the liquid and illiquid assets of a family's estates, and think importantly that there are assets, that are black and white, a building versus a stock and bond account, liquid versus illiquid. But are your private equity investments or your hedge fund investments truly liquid? Are IRAs truly liquid? We're going to talk about that in our next session, but an IRA is subject to ordinary income tax. So the last thing we want to do is to liquidate an IRA to pay a tax, because it really compounds it. So really understanding the mechanics of each asset that you own, and understanding how those are going to be impacted from liquidity and tax. So we put these into an analysis system that we use. We look at the estate, we look at the potential growth of the estate based on your assumptions, and we factor in spending, gifting, and philanthropic gifts into that, because that reduces the lowered value, or reduces the cost or the value of the estate over time that's subject to tax. So the first thing that we'll look at is to say, okay, based on your current scenario, do you have enough capital and income generation to live the lifestyle that you want? And then we can identify, based on current scenario, what your potential tax issues are going to be. Then in the second part of the scenario, we're able to look at varying techniques and test the tolerance of those against your income needs and your family goals to make sure that mathematically that can work. And these screenshots are a sample of what those look like. We'll look at varying life expectancy scenarios, and we can model these. We keep these as working documents, and we update them on an annual basis, so that as families evolve and change, we can make adjustments to that. We also use this system as an opportunity to look at what is going to be left to certain generations. So a trend that I've seen in my career as our clients have begun to live longer, healthier lives. I had a client who's in his 90s. He said, I'm not going to spoil my 65-year-old son. So he elected to start giving some assets down to the grandchildren. We can model that to see how that works, and provide guidance in the best way that you can leave those assets to your family members. So these are sort of samples of those estate analysis programs that we use. And I would encourage anybody on the call today, if you have an opportunity, we'd be happy to engage in looking at your estate and providing the analysis for you. Also, again, very important as we look at this, we look in every year on a year-by-year basis of the projections and what we have liquidity versus estate, and then how these gifting strategies will help us. Consider alternative gifting strategies. Many of you probably used part or all of your unified credit last year, but I've been getting a lot of inquiries about what to do if I didn't use my credit last year. Is it too late? What should I do? Well, as I said, we don't know when they're going to enact all or part of this proposed plan. Historically, it's typically retroactive back to the year, but it may not happen in this year. So there are ways to gifting strategies. There are specialized trusts that we have, and also the ability to give, to sell assets to trusts, and have some options for us at the end of the year when we realize whether or not they're going to take away the tax or not. So I have we work with a number of law firms that have specialized trusts that we could still give the unified credit to the trust. And if we got to the end of the year and they did pass the retroactive law, we have an out provision. So you set it up as though you assume the tax is going to continue in the same regime it is today with the full unified credit of 11.7. But if they take it away to prevent a gift tax, we have an out. So that's something to consider if you haven't used all of your unified credit in the previous year. We also have the ability to take assets and sell those assets to trusts and take back a note, with the same scenario that if we have the credit at the end of the year, we can gift that note either to that trust or to another entity and capture that unified credit. So consider alternative gifting strategies. Those really come out of the estate analysis. So the first most important thing to do is do a review of your estate, analyze the math around the growth and the impact of the taxes. And then from there, we can recommend strategies that fit your family specifically to help value those plans. In addition to that, if you have existing plans that include irrevocable trusts with life insurance in them, very important to do a review of those at least every couple of years. Interest rates being extremely low have had a negative impact on the performance of these products. They still work very well because they have an inherent income tax benefit. They're income and estate tax free if set up properly. So they're fine assets to use in the plan, but we need to make sure that they're going to be there when the plan is needed. With that, I'll cover a couple of questions. I wanted to keep you to 30 minutes today in the hopes that you'll come back for the next session. Figured you didn't want to hear me for 2.5 hours. The question that I have is, what is the best way to leave assets to my grandchildren. And that comes from Bob. And thanks, Bob, for your question. So there are several ways. Depending on your available unified credit and your generation skipping exemption, you can make gifts directly to trusts for the benefit of the grandchildren. So that's one way to do that. Under current law, you can, for annual exclusion gifting, which we each have $15,000 a year to give to any individual. You can gift those into trust, or you can fund, if you have educational needs, you can advance up to 5 years of your annual exclusion credits into a 529 plan, which is a college funding program. Very beneficial for children and grandchildren, because the money, if used for college or educational expenses, come out as a tax-free benefit. They grow tax deferred, they come out tax-free. They can also be transferred between grandchildren, so that's another way. If you have children, where you have a scenario where you have children that are well off in generation 2, we can design the plan for part or all of it to skip your children and go directly to grandchildren based on some limits. So lots of options. Happy to sit down and talk about your specific family and your specific needs that you have. So I have one more question. And the question that came in is, what is the impact of the IRA changes with regard to the new tax proposal? We're going to be talking about that in the next plan, but I'll give you a little teaser. So the Secure Act was passed in 2018, or enacted in 2018. And the Secure Act did a few different things. Most of the Secure Act was designed to enable people, encourage people to save more. So they elected to have more optionality in 401k plans, to have part-time employees the ability to participate. They extended the required minimum distribution from age 70.5 to 72. The only negative thing that they did with that was they took away the stretch IRA. So it forces the IRA out over a shorter period of time when left to the beneficiaries. So in our next session, we are going to cover several options of how to plan for your IRAs and how to potentially leave those to your children or grandchildren, or leverage those assets for them to create a greater tax-free benefit. So if you'd like and have additional questions, you can please feel free to email me at bill@capitalwealthadvisors.com. Our phone number is on here. We hope that you found today, or I hope that you found today to be interesting and informative. We'll look forward to seeing you on our next session, which is about IRA planning. And it will be March 17th at 11 a.m., again, about a half an hour. And then the following week, we're going to do the final wrap up, which is going to dig deep into liquidity and planning options for the new tax regime. So I hope you have a great day, and thank you very much for attending.